So today I want to talk to you a little bit about some research that I've been doing with Eric Kelly, and we're going to look at the issue of which factors are moving stock prices. And then we're going to focus in particular on the roles of financial news and trading activity around the clock, that is throughout the day. So I want to start with a little bit of background. I want to start with some common knowledge, I think, in finance, but make sure we're all on the same page. The bit of financial knowledge I want to start with is that there is a coincidence in timing between the occurrence of financial news, trading activity, and stock price movements if you look at individual stocks. So let me give you an example of what I'm talking about. So Hewlett-Packard, for example, in August 18th and 19th, had some pretty important news to announce to the stock market. In particular, they told the stock market that their earnings were going to be a little bit lower than analysts had previously expected. And they also told the market that they were intending to spin off their PC business. Now, when they released this news around the close of trading around 4 p.m., this is a graph, the blue line of Hewlett-Packard's stock price. It was around $30 at the time per share, and it plummeted very rapidly to around $24 per share, a decrease of about 20%. So as this stock price drop was happening, we saw major news coming out at the same time for Hewlett-Packard, and we saw a huge surge in trading volume in Hewlett-Packard, which is graphed here on the right axis. The red bars are trading volume, and in particular, we saw literally billions of dollars of trading activity as Hewlett-Packard's market capitalization was falling by billions of dollars. So what I want to ask here is, what is causing the stock price of Hewlett-Packard to drop when we see this drop? Is it the news itself that Hewlett-Packard is going to have low earnings and a PC spinoff, or is it the fact that we need traders to interpret that news and tell us what its implications are for Hewlett-Packard's stock price? So I want to ask, is news or trading causing this movement in stock prices? So to answer this question, I think it's helpful to delve a little bit deeper than just this daily graph of close-to-close trading activity shows us. I want to zoom in here on those couple of days in which the news occurs. But before I do that, I want to take a step back and think about, in general, when we think about stock price movements, what are the different possible reasons why stock prices could move in our classical theories? So I think the first of these is, as I've suggested, what I'll call public information or news. So to give you the idea of what I mean here, think about HP announcing their unexpectedly low quarterly earnings at, say, 4:10 p.m. Eastern Time after the close of trading. And then think about all traders seeing this news and just universally agreeing that it's clear that Hewlett-Packard's stock price, it no longer should be $30 a share because now the firm is now worth simply $24 a share. Everybody agrees on this, so there's really no need for people to trade on this information because they all agree on what the value of Hewlett-Packard is. So its price drops to 24 immediately, but we don't actually see any trading activity. So this is what I mean by public information itself moving the stock price without trading activity. What's the alternative scenario? An alternative scenario would be some people have an idea of how to interpret this information, and it's the trading activity by those people that really gets the stock price to its correct value. So what do I mean? Suppose there are only suppose there's a firm, SAC Capital, a hedge fund, that has pretty good knowledge of Hewlett-Packard's business and in particular knows something about who might be willing to buy Hewlett-Packard's PC business. And SAC Capital knows that there aren't that many people that are really interested in buying it. So they infer that Hewlett-Packard's going to get a low price for selling its PC business, so Hewlett-Packard itself is not worth all that much. And nobody else knows this, just SAC Capital knows this. So what do? They go out and they sell a bunch of their Hewlett-Packard shares, maybe, who knows, $500 million worth of HP, and that lowers HP's stock price. So that's what I'll call private interpretations of public information, or just private information or informed trading. So that's another possibility for why the price drops. A third possibility is it's just noise. So this is the idea that the stock price really shouldn't have moved in some rational or efficient sense, but it did move because people traded on this news, and they traded in a potentially irrational or not so sensible way. So let's say Joe Smith, a buy-side analyst with a Harvard MBA, carelessly assumes that HP's currently low margins, presumably from selling PCs, which they're going to get out of that business, will persist in his valuation of HP stock. That produces an equity value in his analysis of $20 billion instead of Hewlett-Packard's market cap, which was $50 billion. So he says, you know what? My firm should sell all its HP stock, and that'll lower HP's stock price. So this is what I would call noise trading, or trading on incorrect information causing the stock price to move. So I'm going to try to tease apart these three different ideas and see which of them seems to be affecting stock prices around the time that news is released. And I'm going to use data to address this question. And the data I'm going to use is going to help me zoom in on trading activity within the day and think about when exactly our stock price is moving, when is the news occurring, and when is trading activity occurring. I'm going to focus on the years since 2001, after Regulation Fair Disclosure was passed. And that regulation is notable because it seemed around that time in 2001 that firms suddenly decided that it was a better idea to announce their financial news when stock market trading, regular trading, which occurs between 9:30 a.m. and 4 p.m., they wanted to announce their news when regular trading was not occurring after Regulation FD. They used to announce their news during trading. They decided to change that. Now 95% of firms announce their news outside of regular trading hours. What we're going to do is we're going to compare what stock returns and trading volume look like during these regular trading hours, 9:30 to 4 p.m., to what these returns and volumes look like during what I'll call extended trading hours. Because since 2001, it turns out, now people can trade even before 9:30 a.m., as early as, say, 7 a.m. in what I'll call the pre-market, which goes from 7 a.m. to 9:30. Then they can trade during the regular hours from 9:30 to 4. And they can still trade again during what I'll call after-hours trading from 4 p.m. to 6:30. From 6:30 p.m. to 7 a.m., there's really basically no trading. And I'll call this the overnight period. So I'm going to divide the day up into these 4 periods and analyze what's going on with news, trading, and returns during these 4 periods. Here's the thing about the pre-market and the after-hours period versus the regular period. The reason I call the regular period is because that's when 99% of trading activity occurs. About 1% occurs during these times. And yet, it's when that 1% of trading volume is occurring, that's when 95 to 99% of the news is coming out. So here we have kind of an interesting experiment here. We've got all the news coming out when almost nobody's trading. So what happens? Do prices get to their efficient level? Well, that's what I'm going to look at. And to measure news, I'm going to look at Dow Jones Newswires. Dow Jones was kind enough to give me their entire archive worth of news stories. And that's the major source for a lot of institutional investors and how they get their news. So I'm going to measure news about individual firms using the occurrence of these news wires. And I'm going to try to distinguish the impacts of news and trading activity on stock prices by looking at which one of these seems to coincide with the movements. So let's zoom in first on that HP example before we get into the general data. What does the HP example look like at a micro level? Well, here's what's going on August 18th when HP first announces the news in the regular trading hours. This is HP's stock price. It moves quite a bit up and down, but on net, really doesn't move that much. Down here's trading volume, the red bars. You can see a whole bunch of trading volume here during the regular hours. Almost all the trading volume, as advertised, occurs during the regular hours. When HP clarifies its news, it actually releases its earnings during trading here. It's kind of a strange event. There was a leak. HP is kind of famous for that now. And after hours, however, HP clarifies the news, and especially during its conference call at 5 p.m., it really tells people that, you know what, we're going to spin off our PC business, but we don't exactly have a buyer yet. So here's how the stock market reacts to that. Boom, 10%. HP's down. How much trading volume occurred? See the red bars down here? If you can't see them, I don't blame you, because they're almost non-existent. The stock price does fall considerably. It levels off after the conference call is over. Phew. The next morning, analysts weigh in with their feelings on the matter, and more analysts downgrade HP. The next morning in the pre-market, this happens, when, again, almost no trading volume occurs. HP's price falls on net 20%, wiping out $10 billion of market cap, while only $100 million transacts, 100 times less. What happens when the regular market opens? A huge surge in volume, the biggest volume day for HP all year. Billions of dollars trade, and the price barely budges. So what gives here? What's going on? Well, this example, at least, suggests to me that we have, to a first approximation, a situation where pure public information is moving prices. And the trading volume is really kind of an afterthought. A lot of it's occurring here after most of the price movement has already occurred. What I want to ask now is, does this generalize? could we really show this example? Seems to hold for all the different firms that have a good amount of trading in the United States over this 1-decade period. So that's what I'm going to look at next. I want to see whether two particular features generalize. Do stock prices typically respond to the news in the same period as the news occurs? I.e., is the return variance, this is one measure of stock price movement, highest in this period? And for news stories that occur outside of regular trading hours, I want to know, does trading volume mainly respond to the news when the regular market opens? So we're going to ask that question. And what I'm going to do to examine this question is I'm going to look at a picture in what we call event time. So what this picture shows is, and in what I'm going to call period 0, this is the period in which the news occurs. And I've constructed this picture so that I'm comparing both return variance and trading activity. Trading activity I'm measuring by turnover, which is volume over shares outstanding. Trading share volume over shares outstanding. I'm measuring trading activity and price movements both when the news occurs and after the news occurs in this picture. So this is for news that occurs in what I'll call the regular period, so between 9:30 to 4 p.m. And this is what turnover is between 9:30 and 4 p.m. And this is what variance is during that period. It's very high. Trading seems to be reacting to the news almost immediately, and variance, prices, seem to be reacting almost immediately too. This is when news occurs from 9:30 to 4 p.m. After 9:30 to 4 p.m. in the after hours period, there's very little movement in trading activity and return variance. It's kind of an afterthought. But this is when news occurs when most trading occurs. So it's kind of a coincidence here, perhaps, that trading and variance coincide. What happens when the news occurs before the regular period, so in the pre-market period from 7 a.m. to 9:30? When do prices move? Well, here's return variance over here. Prices move in period 0, which is, by construction in this picture, when the news occurs. So the news occurs 7 to 9:30. The prices react 7 to 9:30. Here's turnover. Turnover is almost 0 in this picture, meaning almost nobody's trading. When do people trade on the news? Well, they wait until the next period, which is the 9:30 to 4 p.m. period. After hours, almost no trading, no variance, etc. What about if news occurs overnight? If news occurs overnight, when by construction no trading activity can occur, still a bit of return variance occurs. That is to say, prices just open in the pre-market at a different price from where they were in the after hours period. Prices move even more in the pre-market, and then prices stop moving very much by the time you get to the regular trading period. But turnover, again, peaks in the regular period. What if news occurs after hours? If news occurs after hours, 4 p.m. to 6:30, almost all the price movement occurs after hours. Almost none of the turnover occurs after hours. It's not until 3 periods later you get to after hours, overnight, pre-market, and then finally regular trading hours when people trade. So it's as if the trading waits until the regular period, but the prices have already moved. So this example with HP turns out to be a pretty general example. Ultimately, what I think we learn from this is that most news now is occurring in this extended trading hour period. And most price movement seems to be occurring then too. So how does that work? How are prices moving even though there's really low trading volume? Well, apparently there are at least sufficiently sophisticated traders that are conducting their activities during that time who are monitoring the market continuously, even during these light trading times, and rapidly processing the new information. The fact that they don't wait until 9:30 a.m. to trade suggests that these guys can't wait that long to trade, because their informational edge really is only going to last a few hours. That is to say, they're pretty sure everybody else is going to be aware of the news and aware of the correct price by the time the market opens. So they have really no choice but to trade during the extended hours. Conversely, uninformed traders perhaps avoid these extended hours periods, and that's why you see such light trading volume. By contrast, during the day, during regular hours periods from 9:30 a.m. to 4 p.m., that's when it's relatively cheaper to trade. That's when bid-ask spreads, like Larry was talking about in his talk, that's when they're much lower. So the uninformed traders, to the extent that they have discretion over when to trade, they choose to trade when it's cheapest to do so. It doesn't matter to them that prices have already moved. In fact, it's perhaps a benefit to them, because they wouldn't really want to trade with all these informed guys that seem to be trading around the time of the news. So now we live in a world, apparently, where there's some degree of segmentation, connecting back to Geert's talk, between the uninformed traders and the informed traders, where the latter are primarily trading during extended hours. Thanks.